The U.S. 10-year yield, 2.88%. You now have yields up 5 basis points as the selling really takes control. The curve, though, really kind of confused. I mean, the 210 wants to be steeper. Then it was a little flatter. Now it's steeper again. Nathan, what's an appropriate market response to this data?
So we were surprised on the upside by inflation, and some recalibration of long-term Treasury yields seems appropriate. The 5 basis point move that we've seen so far doesn't particularly surprise me. If we start moving into the 2.9 handles, that will be a bigger move. I'm not sure it's justified based on this one data point, but we'll see.
So Michael, as we look at where we're likely to head next, to what extent do we need to take into account what Mike was just talking about, which is consumer spending, or maybe some suppression of consumer spending because of falling savings rates, increased credit card? Are you looking at that as one factor as inflation going forward?
I wasn't sure which Mike you were talking about here.
Oh, I'm sorry.
Michael Ashton.
Michael Ashton, because you're the expert. Sorry.
That's all right. No, I think that, I think what has been said that, let's not overemphasize 1 month here. It is a January number, and that can be all over the place. It is high. It is sort of consistent with the underlying trends. I think those underlying consumer trends, are a potential damper. But on the other hand, you also have potential supply-side developments such as, increasing protectionism coming out of the administration. But look, we've got accelerating global and accelerating core inflation around the globe. I mean, this is not just a U.S. phenomenon. And what we know about inflation is that you don't have to have great consumer spending. You don't have to have a great economy to have inflation. Look at the 1970s in the U.S. as a great example. So, if we go into a hardcore super recession again, then okay, sure, all bets are off. But right now the pricing momentum is sort of established.